On this week's podcast for the Capitalist Investor, with the market being so volatile right now, we're going to talk about the psychology investing, overcoming fear and greed, and essentially behavioral finance and the issues that come along with it.
Hey everybody, and welcome to the Capitalist Investor. How you doing, Tony?
Good, man.
Good to see you.
Diamond hands, are they still diamond?
Oh, they're definitely diamond.
All right.
Yeah, I haven't sold anything in years.
I like it.
Yeah,
I like it. Before we get into today's topic, the psychology of investing, fear, greed, behavioral finance, things like that, I do want to mention the Masters.
Mm-hmm.
I'm going to ring my own bell.
Yep.
I did, call out Roy. I had a very strong feeling on this one, and I was involved. But man, like you said before, like what a mess on.
Yeah, it was hard to watch, honestly.
Yeah,
it really was.
They were like, oh, it's going to be a 2-horse race, and then it became like a 5-horse race.
Yep.
Quickly.
Well, you thought Rory was going to pull away, and then he put it in the drink on 13 from 120 yards out. He that's a par 5. He laid up. That's the one with Ray's Creek.
Yeah.
And yeah, just one of the worst golf shots you'll ever see.
No, the worst golf shot could have been his shot into the green from 120 yards away on the 18th hole and put it in the bunker.
That was bad, too.
That was a bad shot.
Yeah.
And then, he got out of the bunker, and I'm like, he needs to be within 3 feet, and he was like 5 feet. And I'm like, oh, my God, we're 50-50.
Yep.
So,
but great tournament.
Yeah.
It was nice to see competitive golf.
A lot of people, I don't think some of the action was off the course, because Rory was, pre-market, or pre-tournament, like 6-1 or something.
Mm-hmm.
So you got people probably throwing money down.
Oh, yeah.
So it was just fun to watch. I love the Masters. So, all right, man, let's get into this psychology of investing. So I think it's a very important time to talk about this because the market is so volatile. I don't even want to call it volatile. It's just like the Trump, get ready, buckle up. It's going to be like this for the next 3.5 years, I feel.
Yep.
And I don't even know if it is, I know it was volatile. It's kind of calmed down because before President Trump came out and showed his tariff board, the market priced in 8% drawback. Like it was already priced in. They were expecting something, like, hey guys, I'm just going to reiterate this. And then he came out and he was extremely aggressive, very hawkish on all of these tariffs, and the market fell off another 10%.
Yep.
The market did not price that in. No. But as as he went silent over the weekend, and you're getting quote unquote phone calls and people want to negotiate, and then you get a 90-day pause, like what happens? The old saying is some of the best days in the market come not that far behind the worst days.
Yep.
And that's exactly what happened.
Within 2 weeks.
Yep. So the power of investing, it's very emotional because we save our money and we expect it to grow. And one day we want to stop working, right? So, but then we get clouded judgment because of fear and greed. And I actually think it makes our judgment cloudy, very irrational. And I feel like in today's instantaneous, information and instantaneous gratification and the way everything works today, like 1 year seems like a decade, like, hey, last year was great. And then we get 1 week of volatility. And everyone's like, where's the ripcord? Right. So we need to understand our emotions so that we can be successful.
And that's what behavioral finance is. So you mentioned that up top, so that's essentially the study of how people, emotions, their emotions take over, when they are investing, both on the buy side and the sell side, both on the high and the low. So it's being in this business for a while now, you understand exactly how real and how powerful that is, because it happens every single time. We just went through it with the tariffs and just news reports, right? Remember, must have been about 2 weeks ago now. There was like a false report of the 90-day pause.
Yeah.
In the market, it was down 2% and it went up 4%, and then they said it was false and then went back down again. So it is a roller coaster. So and it's all in, and I don't want to say all, but a great deal of it is based on emotions.
Yep. And so some of the common psychological biases are first and foremost the herd mentality.
Absolutely.
The following the crowd. And the thing that comes to mind the most recent is Bitcoin. I mean, like, I've been like, man, I just don't understand, blah, blah, blah. And then it was mooning, going up.
It's NFTs.
And I was like, well, just recently, I mean, right before the election, because Trump's like, hey, I'm going to get a Bitcoin reserve.
Yep.
And that fizzled out. Like Bitcoin was at 120. I think it's at 80,000 a coin or whatever,
80,
right?
82,
it's
somewhere
like,
in there.
and people before like, oh my God, this thing's going to 200.
Right.
And where's all the honkers now? like again, I'm involved, but like not that much. Like it's like a commodity. It's like gold. Like how much? There's some people loading up on gold, and if you've made that move, you've been very well. But gold is getting into uncharted territory.
Yep.
Right. So, but Bitcoin, I like, that's the perfect example. Bitcoin, I need it, but and it's like, I understand it long term, but I don't think it's just gonna moon and get high and go to 200 and just stay there.
Right.
It's gonna come with high volatility. Confirmation bias. It's like, I'm going to read what I want and I'm going to read I'm going to read the same person. I think if you read, I can't think of his name off the top of my head. Peter Schiff. Mm-hmm. You might not have ever made any money with that guy because he's always bearish. Right. Like everything, you would have never made money. Right. And so that's one thing. And then opposing views. Like, I'm just so bullish. I don't want to read Peter Schiff. Right. I mean, I like to read everybody and try and vet like what they're saying, right? And then the last one is loss aversion. Feeling the pain of loss more intensely than the pleasure of gain. 2022 was a bad year. The market was down, and the stocks were down, and bonds were down. But the next 2 years were up 20+% on the S&P 500. That has only happened 5 times in the last 100 years.
Yep.
It does not happen that often. Right? Less than 5% of the time. Come on. Like you don't think we have to give something back? Like, I felt like, and we could still end. Like, if they're like, as of today, China's like, hey, we want to negotiate, but they're being very tactful. Like, hey, we're going to get a mediator, and U.S., you better get a mediator because we don't want Trump at the table. Like you could talk to him after my guys talk, but like they want to have a very constructive meeting rather than like get everything laid out and approved before they go face to face. Is essentially what I'm reading today.
Yep.
Again, that is, there has been, and after we see that, we could see another bump in this market. We could be flat for the year, and that would be a victory after 220+% years, right?
Yeah, absolutely. I mean, look what happened just on one tweet.
Yeah.
I mean. And it's since that tweet, and the market went up. I think the S&P.
What was that? Was that the tweet that where Trump's like, get involved or buy now or buy low or what is that? Is that the one you're talking about?
That one out in the morning, and then the
great time to buy, guys. Like, wow,
actually, yeah. I was going to buy on that tweet. I swear to God, I didn't get any trades in because we were too busy. But yeah, it's fascinating because you can see all this stuff too in like everyday life, right? So like confirmation bias, like look at the the cable news networks, right? There's no conservatives watching CNN, and there's no liberals watching Fox.
Yeah,
you go to what you want to hear, right?
Yeah,
it's the echo chamber.
I'm gonna touch on this a little bit later about like continuous learning and things like that, and how to build a strong mentality. About a way to break that confirmation bias is take a look at a couple things. Like our investment team, they look at macro, fundamental, and technical analysis. So we'll come back to that, but we do have some solutions to some of these things.
Absolutely.
So,
yeah.
All right. So strategies, to overcome this. Obviously, there's diversification. Spread out your investments. Everyone's beaten over the head with that one. Long-term perspective. That one's a little tougher because, again, everyone forgot the last 2 years, and now we're down 8%. And then that's just the index. I've taken a look at client accounts, and they're not down as much as the index. I'll tell you that right now.
Yep.
Right. Depending on how they're invested, it's almost flat. Plus or minus 2% probably at this moment.
Yep.
But again, everyone's different. There's some people that are going crazy and they are down as much as the index. So, but when my team gets involved, they're balancing this stuff out and looking for a long-term perspective, not the short-term, hey, what can pop tomorrow?
Right.
That's not the goal. And then emotional detachment, developing a plan and sticking to it. Avoid the impulses. That is very, very important. And it's market noise. It's very hard to disconnect from the macro news nowadays because it's just in our face, and then it's even amplified with President Trump. Mm-hmm. But those are things that we need to focus on: diversification, long-term perspective, and detachment.
I think emotional detachment is huge, especially when it comes to picking stocks.
It's
right?
the hardest.
Yeah, so it's obviously it's happened before, and we've picked lots of stocks, but it seems whenever I pick a stock for my personal portfolio, it goes down almost immediately, right? And we're in this every day. So if I'm actually buying a stock, it means I'm pretty convicted on it. I'm not, day trading or anything close to that. So to find a stock, you pick it out, you're attached to it, you got a bunch of reasons why it's going to go up, and then you buy it and it drops 10%. It is very difficult not to have emotions come in there, right?
Yeah.
And at that point, the problem for most people is admitting that you're wrong, right?
Yeah.
Having a point where if it crosses over, hey, I made a bad trade, I got to get out of this stock. It's dropped past my threshold, whether that's 10%, 20%. I don't want to jump ahead,
but I've seen our investment team do that on both spectrums.
Oh yeah,
where they have bought a stock and within 2 weeks it went up 30%. Like, wow, guys, like that wasn't supposed to happen. Like we're trying to buy stocks that are just some news came out automatically on a stock, and they're like they got out.
Yep.
They didn't say, oh my God, it's up 30% in the last 3 days. Like, why can't it go to 50? They're like, hey, we hit a target. We're going to exit the position.
Yep.
And we're not day traders by any means, but they do that on the back end too. It's like, hey, we got into a position. They know where, it's sometimes between 10 and 20%, like downward trend is like, hey, it was the bad time. It was a bad time to get in, and we're going to sell it, lick our wounds, and recalibrate and look for the next thing to get back to even. But that's why we also carry 50 stocks,
right?
And not over allocate to, all of these things. So let's kind of get onto the emotional detachment. So how do you build a strong investment mindset? So develop a clear investment plan. Have goals. What is the goal with this money? What are your retirement goals? Like there's probably 3 or 4 different layers to that.
Yep.
Right. What is your risk tolerance? Are you scared of your shadow when you're investing, or are you going to stomach a minus 20 when you first get in, Derek? Like you said, like, hey, I get in, it just immediately goes down. Do you immediately sell?
No.
I'm sure. No. Okay, that's good. I mean, that's impressive.
But if it went past my threshold, I definitely would sell. Yeah.
Right. Mm-hmm. But most people, like if you have a long-term mentality, like risk tolerance shouldn't be, it's there, but it's again, like I don't want to put somebody outside of their comfort zone either.
Yep.
Right. And then the investment strategy. So what does that mean? Do we want to build a portfolio for income, growth, low beta stocks where they're not volatile, or high beta stocks where they are volatile? Mm-hmm. Can you have a blend of all of it? Yeah, depending on how much money you have and how sophisticated we can get with different strategies. But some people don't have that luxury. We have to have a blend of both so that we can be successful. Seek professional advice. And this is where we kind of come in. Some people that I have talked to in the past that didn't become clients of our firm, they can't overcome, the fee that it takes us to help take the emotional stress out of this.
Yep.
Right. They take a look at this and sometimes it's not about investing. I say this, I'll kind of detach just a little bit, but sometimes it's not about the actual investment accounts. It's about retiring on time, building a plan to make sure you're not overspending in retirement, making sure you, again, retire on time, when to turn in Social Security, you name it. Like, hey, can I buy a second house? Right now that I'm retired, I want to get out of Cleveland or get out of the cold, whatever, wherever you might be living. And then taxes. I always say this, like, hey, when we incorporate the tax professional with our clients, there's a number on your statement on how much money you made or lost that month, that quarter, that year. But there's also a number that's just not going to show up there, and that's how much money lands at the bottom of your checking account because there was a tax move. I can't strap that onto your investment portfolio. Yeah. I can't do that. But if you can realize what the bigger picture is, and doing things efficiently actually adds percentage points and alpha to your overall investment strategy.
Yep. Yeah, I think seeking professional advice is, the subject we're talking about today. That's one of the main things that they should help you do, is help you pull the emotions out of investing.
Right. And I always say this, like, focus on what you're good at. I use this analogy because I'm kind of handy, but I also don't know. It's just, I know what I'm good at. And if my sink starts leaking, I'm going to turn the water off. I know where that button is, right? But I'm going to call a plumber.
Yep.
Because once there's a problem with your plumbing, man, like, water finds the weakest link, and I don't need a foot of water in my basement. Right. And same thing with electricity. I don't want to kill myself.
No, you're not. Don't mess with that.
Yeah. So,
but yeah, I was going to say so detaching the emotions is one of the big things from professional advice, but it's also helping you set goals. How often do we sit down with people, people we haven't talked to yet, and they're just so laser focused on returns. What is your return versus the S&P 500? Obviously that stuff is important, but this goes back to setting your plan, especially as you're approaching retirement. When you're approaching retirement, you don't need to be hopefully hitting home runs in the market. If you do, then you should probably take a look at your plan.
Yeah.
It's not necessarily just about getting conservative just for getting conservative. It's about having a plan, right? You need to understand what we need to get, what's the bogey, and what does the diversification mix look like to get there.
Yeah.
It's reducing that overall risk so you can sleep well at night.
Yeah.
And I think, you have more and more conversations. It's for people who are overly emotional. They are tied to that investment return number, and it shouldn't be that way.
Yeah.
Mark Tepper here from SWP Investment Management. It's time to elevate your portfolio with the SWP Growth and Income ETF. A diversified basket of high-quality growth companies that pay dividends, SWP stands out from the pack because total returns matter. Don't just invest, thrive with SWP. Visit investswp.com for more information. Disclosures apply.
Again, so we have to understand where we're getting our information from, and I was touching base on this before. That's why I every 2 weeks when we listen to our investment team, they give us the macro picture, what's going on around us, what's happening on TV, the macro analysis, so that they can explain to the fundamentals, right? Saying, hey, we're going to be in a volatile time. Like, we should probably start looking at more value stocks than growth stocks, right? Because the growth stocks are going to be most affected by tariffs. And then also, but then there's this thing where, like, hey, the Fed might be cutting. Well, guess what? That's good for, growth stocks, right? So, like, there's this pool, and so how do you navigate through those two things, because they're conflicting? And then technical analysis. Just because you like something, it might not be the right time to buy in. It might be overvalued as you're looking at it.
This is huge. Yep.
Yeah, and I know that there's a couple examples that I know of my team, and it's like, hey, it's on our radar. It popped 10% in the last 3 days, and now it's continued to be on our radar. We were about to buy it, and we missed it because there was a geopolitical macro event. There was you were looking at General Dynamics,
right?
As just an example, and they didn't buy it for quite some time. After the war in Israel happened, and that stock took off because it's a defense company. So.
Yes, Peloton is a great example of basically everything that you just said. Remember that stock during the pandemic, and it went from
my God,
$19 to $200. Relative value is definitely a thing. And that, because everyone has an opinion, right? If say company A, B, or C, everyone has a thought when you say that name. But it's not just about the name; it's about what they're doing, what they're producing, and how expensive the stock is. I know that sounds simple, but when I'm out talking to people, everyone has an opinion on this stock, and it's a great company. But it may be a great company, but it might not be a great investment right now, just based on the price.
And actually, by the time you realize, hey, my God, I didn't even think of that stock, you're too late. There's a reason you found out as the general investor.
Yep.
You're behind the eight ball already. Is there still maybe juice to squeeze out of Peloton? Maybe you saw it, like you said, would it go from 20 to 200?
Yep.
Maybe you caught it at 100 and you're like, you still got 50% gain, but you didn't get 8x.
Right.
Right. You got 1x or 2x, right?
But I wonder how many people got in at a decent level and rode it all the way up, and then rode it all the way down because they're emotionally attached to that investment, and they saw how much money was in their account before, and they just want that feeling back. That's exactly what we're talking about here.
Yeah. All right. So as we wrap this up, some practical tips for the rational investing is invest in what you understand, right? That's kind of like, personally, it's like Bitcoin. I understand what it is. I know what it can do, but I'm just trying to be practical, man. I cannot take my crypto thumb drive and buy gas for my car. I can't do that. At least not that I know of. So again, invest in what you understand. And then, and then we also need to understand that it can be high risk, like Bitcoin. I keep on using it as an example, but when you're going to be high beta, high volatility stocks, invest in what you're willing to lose. Because this, Bitcoin, micro cap stocks like Peloton, it's another, again, we'll bolt onto that. It's invest in what you know. Yeah, we know it's a bike. Do you know anything about the fundamentals? I know that everyone's trying to buy one and they're sold out, and that's why the bike's flying out and everyone's locked at home. What happens when we get out of our cages after the stay-at-home stocks are over? What happened? It's crashed.
Yep, thanks.
Do they even make them anymore? Yeah, they have to, right?
Yep.
Yeah. Okay.
But now it's properly valued.
Yeah.
It's a exercise company, an app, and they make
it's a subscription.
exercise equipment.
Right.
That has not historically been a great business to be in.
Yeah, I mean they're going to make their money on the subscriptions, and really not the hardware, the actual bike, right? Focus on value investing. This is important because especially as maybe as you're getting prepared for retirement or in retirement, value investing is very important because we're looking for companies that are undervalued with strong fundamentals, and this is the hardest part of the game. You have to know what you're looking at. The two things that come into mind immediately are look for historical PE ratios of every firm, right? Of every company that you're looking at. Hey, where's this thing traded on a PE ratio over the last 5 years? Is it higher or lower than it has? What caused it to be higher? What caused it to be lower? So there's fundamental analysis that you have to drive into to figure out hey, is this PE ratio just low or is it low for a reason? And then also we've talked about this in our educational classes. What about book value per share? Right? hey, if this company went out of business and they liquidated everything, the chairs, the equipment, the TVs on the wall, whatever the assets they may own, will there be money to pay the actual stockholder, right? Because the bonds get paid out first, and then the stockholders, like, another way, be like, hey, like if they go out of business, I'm actually going to make money because they actually have things to sell. They don't have a lot of debt, but something else happened, right?
Yep.
So, and then avoid market timing. God, no one gets that right. Talked to an advisor the other day, and couldn't talk one of their clients off the ledge, and right before, as the market was down 10%, they're like, get me out. And what happened 2, 3, 4 business days later? It went up 10%, right? Obviously, we gave half of it back the next day, but we're still up probably a net 5% from that moment. And you can't miss that. You can't miss that delta. You can't miss that net positive return.
Yep. So the market timing thing is the one, you really have to drive home. There's some things, you'll never forget. I had one of those clients back in COVID, and basically, and when you look back at it now, it really was not that long of a period of time when the market was down, but it was such an unknown, and no one knew what was going on, and everyone was getting locked in their home. I had one guy just like that. He said, Derek, thank you for everything that you've done for me, but I cannot handle this anymore. I'm gonna go to cash and I'm gonna go on my own.
What happened? The government printed trillions of dollars and the market rejoiced, and sayonara from there, man. That is gone.
He would have recovered everything he lost within 2-3 weeks of when that happened.
We recovered within about 40 days.
And I obviously that was many conversations in. I telling them basically everything we're talking about right now. So yes, have a plan, stick to the plan, and like we've been saying, analyze what's going on there. It's is it a long-term systemic problem, or is it headlines that are manipulating the market's the wrong word, but is it probably short-term pain based on headlines that can be corrected. If it's a long-term sustained downturn, then maybe we need to take a look at the overall mix. But this is investing today. There's going to be highs, there's going to be lows. The market is not going to go straight up. The market's not going to go up 20% every year. You have to stick to your plan, and you have to be willing to ride the volatility, because it's always going to be there.
Yeah.
It was there with the last administration. It's going to be there with this administration.
Yeah, I have a lot of, not a lot, but I had a couple of clients saying, "Oh my God, Tony, I'm about to retire, and like this market's down 8%." And I'm like, "You're not down 8%, and you were up the last 2 years.
Right?
Like, it overshot what we actually." How we built our plans is we build in conservative investment models, and you overshot those last 2 years. Like, you're still fine. You're actually better than what we predicted by design, right? So again, having true planning software helping navigate some of these decisions that are just sometimes you can't quantify them in your head. It's just sometimes maybe too complex.
Yep.
So. All right, man. Well, I hope this was helpful for a lot of people. Spent a lot of time on this, hit a lot of different topics, but it's basically have a game plan.
Yep.
And the game plan's just not like, hey, I'm going to invest and stay invested. Like there's a lot more layers to it.
Yep, for sure.
Right. So
yeah, thanks thanks everyone for listening this week. Keep those show ideas coming. info@swpconnect.com is the best way to get a hold of us. And we'll talk to you next week.
the opinions expressed in this podcast are for general information purposes only and are not intended to provide specific advice or recommendations for any investments, legal, financial, or even tax strategies. It is only intended to provide education about the financial industry, so please consult a qualified professional about your individual needs.